Okay, fun seekers. Here it is. Here's the entire semester, the entire class, the entire world of investments encapsulated in a single presentation, because we are going to discuss the eternal struggle between risk and return. Do you want to eat well, or do you want to sleep well? Yeah, it's actually very simple, but it ain't easy. Slide 35. Investment return revisited. Over the long term, equities, stocks, companies, businesses have produced the best returns from securities. Remembering that there's a whole world out there called real estate, and we'll deal with that later on. So stocks, we tell people 8, 9, 10%, even though some have done a whole lot better, some have done a whole lot worse. Fixed income securities, bonds, loans, are treasury municipal bonds, and then corporate bonds, and they've done, 3, 4, 5, 6, 7%. It depends on how much risk you want to take, because there's risk spectrum within bonds. It has to do with their credit ratings. Just like people have credit scores, yes. And then short-term investments, guaranteed, many of them are cash. We call them short-term vehicles. They're not going to produce very much because they're guaranteed. Low risk, low return. And mutual funds will more or less, often less, reflect the underlying assets they invest in. That's pretty straightforward, right? Make sure you memorize these. The numbers are not hard and fast, but just remember, stocks are going to give you the best returns, unless the world ends. Bonds are going to be somewhere in between them and the short-term and guaranteed investments. Slide 36. The news is good. Here is a graph that shows what's happened to stocks, businesses, bonds, loans, treasury bills, which are a form of short-term securities, short-term investments, and then inflation. From 1928 until 2024, December 31st. And, stocks have done pretty darn well. $1 has turned into almost $10,000. Now, bonds have done, pretty good. $81, not bad. Handily beat out the banks, the short-term investments, the treasury bills, and the like, which have barely beaten inflation. But what's the problem here? The problem is we're using a logarithmic scale. Now, if I were the emperor of mathematics and arithmetic and showing numeric information, I would require a warning label, like there are on cigarettes, a warning label on all logarithmic scale graphs, because people don't really understand logarithms. It doesn't go 1, 2, 3, 4, 5. It goes 1, 10. Where's my cursor? 10, 100, 1,000, 10,000. Every increment is an order of magnitude. And why do we do that? Because it allows us to turn an exponential graph, having to deal with large numbers, into a linear graph, a line graph. So it looks like it's a straight line. It's anything but, folks. Those little squiggles that you see are big jumps. And if people don't really understand that, they might say, oh, well, bonds have done about half of what stocks done. No. It's orders of magnitude more. In fact, if we were to look at it in a arithmetic scale, slide 37, this is what it would look like. Right. The first, 60 years is barely any movement whatsoever, because it's an exponential curve. And so finally we start to see stocks do the wee up in the air, but we also see that these little squiggles that were just downturns can be quite dramatic. Right. And also, we don't see anything else, right? The bonds, the short-term investments, the inflation, they don't even register on the graph. So that's why we use a logarithmic scale for investment alternatives. But as we've mentioned, it really masks the vast difference that you're going to get from investing in businesses, assuming the world doesn't end, than if you invest in loans or savings accounts, short-term investments. The news is good. And in fact, if we turn our clock back to the beginning of the Industrial Revolution, 1801, what we find is that $1 in the stock market has become almost $70 million. Now, there's some, not controversy, but there's some fuzziness in here. Some of these numbers are some estimates, but they're pretty darn close to what actually happened. I mean, bonds did pretty good. $1 became almost $50,000, and holding your money in a bank for that long enough at least turned $1 into $6,000. But look at gold. Every semester or so, every couple of semesters, there's always somebody who's, oh, when are you going to talk about gold? Like, yeah, later. It's really not the best investment. And when people say, I want to invest in gold, I show them this graph and I say, you want to invest in gold? Go invest in gold. Gold does well when people believe the world is going to end. And, someday the world is going to end. But as long as it doesn't end, businesses, the corporations, the companies that essentially are our lifeline, how we stay alive, folks, this technologically based civilization, are the conduits for our investments. There are our ability to partake in the growth of the global economy, and at the same time, keeping people fed, clothed, and sheltered. So it turns out that if we take a long-term perspective and don't panic, stocks are the best financial investment. Again, real estate folks, don't worry, we'll deal with you later on. Cool? Okay, all right. We can't just talk about return, can we? Oh no. We've got to go to the other side of the coin, slide 39, and talk about risk. The eternal struggle. It is no accident that stocks and bonds have produced better returns than short-term investments. Cash, instruments, cash, short-term investments. What do you want to call them? Cash. Otherwise, why would investors assume the higher risk of stocks and bonds? And the answer is they wouldn't. If they could get just as good a return from a savings account as a stock or a bond, they'd say, I'm going with the guaranteed investment. They would just assume the risk-free rate of return. So it's another, when you see something italics or bold, yeah, it's going to be on the exam, all right? And it's in the study guide, folks. This is the return on guaranteed short-term investments. And typically what the industry uses are treasury bills. And we'll discuss those in the next presentation when we get short-term investments out of the way. So we look to it's just mostly they use the 3 month. There's 1 month, 3 month, 6 month. What kind of return are you getting from treasury bills? Because, the United States Treasury does pay its debts. Don't worry. Don't let anybody tell you otherwise. Politically, who knows? Some people want to play Russian roulette with the debt, but that's political. Go talk to your political science professor. No, stocks and bonds have to give us a better return, or people just wouldn't bother investing in them. The risk premium is the reward for bearing risk, the extra return on a risky asset over the risk-free rate of return. So on slide number 40, we see the investment returns from 1928 to 2024, and then we see the risk premiums. So stocks as a whole, and there's this list of stocks that we use as our benchmark, and we'll talk about that in more detail later on. It's called the Standard & Poor's 500. You've probably heard of it. It's a list of about 500 companies. And we tell people 8, 9, 10%, but look, it's actually done 11.79, almost 12%. So if you look at the treasury bills over that time, they've done like 3.38, 3.4%. a little bit more than what the banks would give people. And so our risk premium for taking stocks is 8.42%, about 8.5%. That's what it's been in the past. Now, what's it going to be in the future? We don't know. That's why it's called the future. But, things have been pretty darn good for companies. And it makes sense when you think about the difference between our standard of living back in the 1920s and our standard of living now. It's exponentially better. Corporate bonds have done pretty darn well. 6.88%, kind of like a mortgage. And the risk premium is 3.5%. Treasury bonds have done a little less than 5%. Well, that makes sense. Treasury, don't let anybody tell you the Treasury going bankrupt. It's not. We have serious issues that have to be dealt with, but the United States will pay its debts. But notice the risk premium is only not even 1.5. Yeah, so you're not getting paid a whole lot more risk premium when you go with Treasury bonds. But stocks, yeah, businesses, corporations. I don't like the term stock. I like the term business. So slide 41. Risk versus reward. Risk versus return. Do you want to eat well or do you want to sleep well? Investment return is very straightforward. How much did we start with? How much did we end with? There's our return. But measuring how much risk you took to receive that return is much more difficult. It turns out it's pretty near impossible. Because how do you predict in the future? You can't. Each year, the investment community measures the average annual return and the amount of variance from the average return. Using statistics, the resulting measures of risk are called variance and standard deviation. Oh no, Poliano, I'm going to drop the class. I hate math. Relax. You don't have to do any of these calculations. All you got to do is have an internet enabled device, and it's right there for you. Look it up, and of course you can always go to the library, the fount of all information, and it's done for you. We will leave the calculations for your statistics class. Suffice to say that the higher the variance in standard deviation, the riskier the investment. The higher the variance in standard deviation, the more the investment return will deviate from the average annual return. Now, why do we use all these stupid math symbols? Oh, ask the mathematicians. I never liked it. Why can't we use words like sum or average? No, we have to use these symbols that nobody understands. What's this thing? Epsilon, right? And so how do we calculate the variance? Well, this R sub I means the return for every year when we did 1928 to 2024. And what we do is we subtract that from the average. Well, the average, you know how to calculate the average. You add up all the numbers and you divide by the number of numbers, and that's the average. And what we do is we subtract that for each year. Every year we subtract the return we actually got from the average. And then we square it. Why do we do that? Well, that gets rid of any negative numbers, right? Because with negative numbers and positive numbers, they would get canceled out and it wouldn't make any sense. So we square it and then sum them and then divide by the number of numbers minus 1. What is take it in a statistics class and learn about the central limit theory, central theorem. What is it? I forget the name. Yeah, and that's the variance. And how do we get the standard deviation? Well, you take the square root. So after squaring everything, then we take the square root. And again, if you absolutely hate math, don't drop the class. Don't worry, you're not going to do these calculations. They're just fancy schmancy terms for you can lose your money, or you're not going to necessarily get the return you think you're going to get. Here is the distribution of annual returns on common stocks from 1926 to 2004. Now, what is this graph trying to show you? Every year, we find out what the stock market did, and we plot it on this graph in a sometimes called a frequency distribution or a histogram. And so we see that 1926, 1944, 1949, it was between 10 and 20%. 1942, 1943, 1951, it was between 20 and 30%. And we see that they cluster around between 0 and 20%, 30%. But there are some outliers. There are some years that have done very, very well, like 2013, 1958, 1954, And there are some years that have done very poorly, like 1931, the depths of the Great Depression, 2008, 2002. Yeah. Does this, oh, by the way, look at 2023 and 2024. 2 years of over 20%. Well, folks, when that happens in the past, it's usually a bad sign, like 98, 99. But it doesn't necessarily mean that it will be bad. We shall see. That's why they call it the future. Does this distribution resemble anything that you are familiar with? It should. The normal curve, the normal distribution, the bell curve. You know, nature's been actually kind of kind to us in that many things in nature, the height of individuals, the distributions of various things like how long a car battery is going to last, they tend to follow the normal distribution. There's an average, and then there's a cluster around the average. And so when we calculate the standard deviation, we're seeing how far we're going to be in any given year from, what the probability is of how far we're going to be from the mean, from the average in any given year. So we said that the average for stocks has been 11.79, 11.8% over the last, whatever, almost 100 years, right? 28 to 2024. So if we go plus or minus one standard deviation, we find that there's about a 2/3 chance, a little bit more, 68%, are going to be somewhere in between plus one standard deviation and minus one standard deviation. That means there's about a 2/3 chance that the return is going to be anywhere between minus 7.6 up to 31.2. Now, this is the past. It's not a guarantee of the future, but it gives us a feel for what we can expect. There's a 95% chance, that we're going to be 2 standard deviations away, minus 27% all the way up to 50.6%. And then there's a greater than 99% chance, less than 1 in 100 years, that we're going to be 3 standard deviations away, minus 46.4% up to 70%. Investment returns over time tend to mirror a normal distribution. So armed with this information, I hope you'll feel a little bit more comfortable, because if you lose 10% in 1 year, well, hey, that's not unusual. It happens. But unless the world ends, we can expect that we're going to do pretty well over the long term if we don't panic. Are you with me? Yeah? Okay. Because here is another view of risk versus return. Now we see the average return for the 4 items that we looked at before: stocks, companies, businesses, corporate bonds, treasury bonds, and then treasury bills. But we also see the standard deviation. You see, the standard deviation is almost 20% with regard to stocks. The greater the average return, the greater the standard deviation, and the riskier the investment. Corporate bonds have about, almost 8%, and notice that they're actually a slightly tad less risky than treasury bonds, but they're almost the same. Even treasury bills have a very small standard deviation. And it's interesting, less than the consumer price index, which can vary even more than treasury bills. Does that make sense? Yeah. The higher the higher the return we want, the more risks we're going to take, as measured imperfectly by standard deviation, because we don't know what's going to happen next year. So now we can return to our global view of risk versus return. We can complete the global picture regarding risk versus return. Who had the best risk-adjusted return? Yeah, Sweden may have had the best average annual return, but you had to accept over 30% more risk than the United States to get that return. And in fact, the United States is one of the best, if not, well, it's, Canada's pretty close in terms of a risk-adjusted return. And that's why that's why the United States stock market is the envy of the world, Investors around the world know they're going to get a decent return and they're going to accept less volatility unless the world ends. It's not a guarantee for the future. Make sense? And now look at Austria. Look at Italy. Look at Spain. What a bad deal that is. You're getting far more risk and you're getting a less return. And why is that? It's a lot to do with the population, right? The population shrinking. We in the United States and Canada have often grown our economy through immigration. Oh, that's a bad word these days. I apologize. The immigrants who come and start businesses and work harder than we Americans who grew up here. Yeah, okay, let's not get into politics. Remember, poly means many, and ticks are blood-sucking insects. Slide 47. So, does you got it yet? Yous wants high returns, you's going to get high risk. You're going to lose some money. Depending on what you invest in, maybe all's your money. And if anybody tells you differently, they're lying. They're lying. Because history tells us, it ain't going to happen. High return with low risk, it's a flying panda. It doesn't exist. So when, not if, you see an advertisement for a 12% safe rate of return, you will know that the chances of losing your money are pretty high. When you see claims such as 300% or even 3,000%, and folks, you will. If you get it all involved in investing for any length of time, you're going to see these charlatans. One of them's coming back into the White House, and they're con people. They will steal your money, and they will not have any remorse whatsoever. By the way, they're also breaking the law, huh? Don't we have freedom of speech? Well, yes, in many areas we do, especially the area of the political arena. But when it comes to finances, no, you don't have freedom. You can't advertise a 20% risk-free rate of return because it doesn't exist. The problem is the Securities and Exchange Commission just has a skeleton crew to take care of these people. This one guy, Wade Cook, look him up. He was doing this shenanigans for over 2 decades until they finally shut him down. And they shut one down, they start up someplace else. They're con men, they're con women. The same thing happens in the medical world. There's a wonderful link on my website, I think it's in Canvas also, to nutritionfacts.org. And one of these videos that this wonderful man, Dr. Michael Greger, notice his website doesn't have any advertising. Neither does wonderprofessor.com. Yeah. They found things in these weight loss supplements that shouldn't have been there. like Prozac and Viagra. These are drugs that you only get through prescriptions. Right, folks. So buyer beware is the saying we hear, right? Do your research. And just realize that they're out there. They'll take your money and not feel any remorse whatsoever. Yeah, there's scams out there. That's where the money is, right? But isn't somebody doing it? Well, yes, as a matter of fact, it is true. Some people make tremendous rates of return. But those people are not investors. They are traders, speculators, traders. And they're not looking for long-term results, folks. They're short-term buy and sell traders. And some of them do really well. It's incredibly stressful. And here was one of the first speculators, Jesse Livermore, who was back in the days of the Roaring '20s and the like, the '30s, and then the Great Depression. And he said it best, I think. The speculator is not an investor. You see, he's saying you're not an investor if you want to speculate, if you want to trade. His object is not to secure a steady return on his money at a good rate of interest. No, but to profit by either a rise or fall in the price of whatever he may be speculating in. He eventually committed suicide. Yeah. Being a trader can be very profitable, but it is also very stressful and very perilous, folks. You're up against the best in the world because that's where the money is. Have you ever been in a batting cage that throws the ball at 60, 70 miles an hour and then realized that the pros are throwing it at 100 miles an hour? Can you dunk a basketball? Can you hit a little white ball 300, 400 yards down the fairway in 3 shots? Just because you and I can't do these things doesn't mean there aren't people who can. And you're going to go up against them? Lots of luck. So do you want to be an investor or a speculator? Look, we can help you. We can help you learn how to become a prudent, patient, successful, long-term investor. We can't help you learn how to become a successful short-term trader. I apologize. I can't do it. I'm not even going to try. And if you think you have the gumption, you have the wherewithal, the motivation, and the talent to do it, I want you to read a little story, listen to it, and it's in a book, wonderful book called Liar's Poker, of the battle between John Gutfreund, that means good friend in German, versus John Merriweather. John Merriweather was the best bond trader in the world back in the 1980s, and then went on to be one of the partners in a company called Long-Term Capital Management that almost crashed the stock, that crashed the financial markets around the world. And you, dear students, don't ever want to play liar's poker with John Merriweather. And as we remind you, Mike Gitlin from the Capital Group said it very succinctly: invest, don't trade. Okay, Piano, so what's a realistic rate of return for me? After you have taken this course, you will have a strong knowledge of the most popular types of investments: stocks, bonds, short-term instruments, cash, mutual funds, and a few others. You will also know what levels of return and what levels of risk you should reasonably expect to receive from these types of investments. And if you are a patient, long-term, prudent investor, I believe it is realistic to expect 8, 9, 10%. I mean, I'm certainly working on it myself, and you know what? So far, so good. And it's been a long time. I'm old. Of course, as we reiterate time and time again, there are no guarantees. Once you leave the safety of a bank or other credit union or other short-term guaranteed or pretty darn close short-term investment, no, there's no guarantees. So that begs the question, slide 50, is 9 or 10% good enough? Well, it turns out the answer to this question is yes, but there are some constraints involved, right? If you start early, if you are patient and consistent, if you do not get too cocky or greedy and do not chase after every next big thing that comes along, and now you hear FOMO, right? Yeah, no. Most importantly, you don't panic when the markets swoon, as it inevitably will do from time to time. We know it's going to happen. We just don't know when. There are people who will tell you that they know when it's going to happen, and they're usually very wrong. This one guy, Porter Stansberry, he's been doing it for 25 years. Every year he says the market's going to crash. And then when he's right, he goes, hey, see, I predicted it. Well, if you predict it every year, eventually you're going to be right. And you know, I know some of you are very frightened, and you should be. You need to have some healthy skepticism. That's why you're in the class. We're going to show you some investments that have done well over decades, and we're going to show you some that haven't done well over decades. But people often feel, well, what if I lose everything? It could happen, depending on what you invest in. But if you follow the concepts and the techniques and the tricks that we learn about different kinds of investments in this class, it is very unlikely that you're going to lose everything. From time to time, you're going to lose some money, folks. I'm not going to lie to you. And we're going to see some examples, especially when we get to chapter 2, of stocks, of investments that have done very, very well. But there are some times when it's not too much fun to lose, a ton of money. In fact, it's kind of painful. And everyone I talk to, and I feel the same way, it feels like somebody punches you in the gut. But think about it, folks. If you invest in the kind of companies that we're going to look at in this class, many boring companies, we'll see some more exciting companies too, and they all go to zero. The entire stock market goes to zero, and then the bond market falls. Do you know what that means? It means technologically based civilization has fallen, cracked, and dissolved into a pool of tears. It means you wake up in the morning and there's no food at the grocery store. There's no gas at the gas station. There's no clothes anymore. The cell phones aren't working. The utilities aren't pumping out electricity or gas. The trash isn't being picked up. The sewers are backed up. Look, folks, if that happens, your investment portfolio will be the last thing on your mind. We'll be all out there digging for beetle grubs and boiling bark for dinner. I hear moth soup is actually kind of tasty. I don't think that's going to happen. I know there are people who do, they're survivalists, and if you really do believe that's going to happen, get out of the northern hemisphere. Go to Tierra del Fuego or Tasmania. Learn to raise goats. Because if we're on this together, failure is not an option. And as I said, and I will say, I'm very optimistic about the future. There are technologies that are coming down the pike that are just life-changing. And so I will have a bias toward optimism. And the pessimists just say, well, he's not being realistic. Yeah, we'll see. And I'm old, folks. Usually, as you get old, you get more bitter about the future. I'm actually very excited about the future. I can't wait till I have driverless cars. I hate to drive. And we're going to cure cancer. We're doing it, folks. The immunotherapy, these things are just unbelievable. And this is a real cute story. I hope you don't mind if I bore you with this story. My wife works at social service agencies. Well, now she's a volunteer. She's retired from full-time, and she volunteers. And she had me come and speak to the immigrants from the Middle East who are learning our culture, learning our language, learning how to assimilate. These are people that we had to get out of the Middle East after we left because they had helped us. And so I was trying to be positive and uplifting. And I said, are you having trouble learning English? And this is all through interpreters. There were two interpreters, because usually there's sometimes three, but there was the Pushtan, the Afghani, and then there was the Arabic, right? So it's all going through interpreters. I said, are you having trouble learning English? And then the interpreters, and they all nod, yes! Yes, we are. I said, don't bother. And the interpreters looked at me and they said, yeah, tell them that. And they look at me like, what? I said, pretty soon, we got it, but it's not very good yet. Pretty soon you're going to put something in your ear and it's going to be hooked to your phone, or maybe it's standalone. And all you have to do is listen to what that person says, and that thing will automatically determine what language that person is speaking and translate it to your language. And they all started clapping. Can you imagine, folks? They read from right to left. I mean, just that change from reading from right to left to right. Yeah, God bless them. The trick, folks, is to take advantage of the time value of money, called compound annual return. Slide 51. The time value of money is the amount to which a sum you invest now will increase based on a specified rate of return and time period. Calculating amounts into the future is called compounding. It's also called the future value of money. We can do it for a single amount, a lump sum, a lump sum principal, a single payment, or we can do it for a series of deposits, a series of payments. I like to think of it as a stream of investments. Think of it like a river that gets larger and larger as it goes towards the ocean. You'll also hear people use the term annuity, but I don't like to use that term because an annuity is also an insurance product. Not a very good one. Remember, I'm an insurance agent, so I can say true things about insurance. We'll thwack them at the very end of the semester. We will also learn how to move from the future back to the present. It's just the inverse operation. It's just the other side of the coin. And it has a really bad name. It's called discounting, which drives people nuts, or the present value of money. When we learn how to assign valuations to stocks and bonds, we will be using the present value calculations. Okay? And don't get worried, folks. They're very easy. We use a table. We just look up a number, boom, and it's done for us. And some people will have an application on their phone or use one of the spreadsheets to do it. But we're going to learn how to do it manually, and then we're going to show you spreadsheets that do it automatically for you. So if you are so inclined, there are some future value exercises in Chapter 1. You do not have to do them. They are optional. They will not be on the exam. But I hope that you at least look at the answer key and show you the news is good. If we are consistent, patient, prudent investors starting early, then we can build substantial wealth over our working careers. Yeah. So check it out. But remember, not on the exam, not in the assignment, just something to show you. And we're going to see it even better. We're going to see even better examples when we get to Chapter 2 with mutual funds. So one last comment on risk versus return, folks. Psst. Here's one of Payano's secret tips. Avoid large losses. Yeah. Where would you put $100? So you see two investments. The one does 85% in 1 year. Whoa! Investment B, 10%. The year number 2, investment A does negative 50%. Investment B does 9%. So you might be tempted. Well, 85. No, the numbers going up ain't the same as the numbers going down. So after 1 year, that $100 becomes $185. Investment B becomes $110. After 2 years, a 50% reduction brings us down below our initial investment. The investment B is now up to $120. Avoid large losses. And we're going to learn how to do that by looking at companies that are boring. And yes, every once in a while you might want a hot stock. That means you're going to get burnt usually, but you might do well. Yeah. Okay. Before we embark on the process of identifying and familiarizing ourselves with the longer-term, higher-yielding instruments that we're going to spend much of the semester on, let us learn how and where to park our money using short-term investments. So our next presentation, our last presentation of Chapter 1, will be short-term investments. And they're kind of boring. Well, they better be. They're not supposed to be exciting. But wait a minute. Whoa, wait a second. One more time. The greater the variance in standard deviation of the average annual returns on an investment, the greater the risk. The more volatile the investment is, the lesser the risk. The less volatile. There is no correlation whatsoever, meaning there's no relationship. And we'll discuss correlation later on. Standard what? I always hated statistics. Look, folks, don't get this one wrong on the exam. Please, it's bad for my self-esteem. The more return you want from your investment, the more risk you're going to have to accept. And so what we're going to learn, though, is how to handle that risk emotionally. Right. We're going to learn that volatility can be turned to our advantage if we don't panic. As Warren Buffett likes to say, investing is simple, but it ain't easy. Thank you so much for being in our class. We hope you're getting an education. We hope this is making sense. Go back, listen to it again. You're going to catch some things that you missed. You can pause it. Some people say, Payano, you need to make these things no more than 5 minutes. And I say, no way, I'm not doing that. I'm not doing it. You got the pause button. You can come back to it later. But we're really proud of you. We want you to be successful. We want you to be awesome. We want you to be rich. And remember, there's a future for you in the industry. Think about it. Did we mention that the salaries are higher than the national averages? They want more women. They want more minorities, multilingual, and they simply love veterans. So thank you again for being in our class, and we'll see you in our last presentation of Chapter 1, where we learn where to park our money with short-term investments. Thank you again for being in our class.